Welcome to Talk Tickers. We're your essential deep dive into the latest earnings calls, really trying to give you that critical perspective, maybe uncover some hidden narratives. Today, we're dissecting the Q2 2025 earnings call from Dick's Sporting Goods, ticker DKS. And, while the numbers look fantastic on paper, the market's reaction, well, it tells a much more complex story, one we really need to unravel.
It really does. I mean, Dick's Sporting Goods, they're a major force in sports retail, no doubt. And this particular earnings call is just a fascinating case study. It's not just about their current operations, which look good, but how these recent strategic moves, especially that big acquisition, are really shaping how investors feel, sometimes even overriding what looks like stellar performance.
Okay, so let's unpack those headline numbers for DKS's Q2 2025, because like you said, on the face of it, they are incredibly strong. They reported non-GAAP EPS of $4.38. That beat FactSet estimates by 0.08 cents. Pretty impressive. Revenue came in at $3.65 billion, also surpassing estimates by about $0.04 billion. And that's a solid 5.0% year-over-year increase. And maybe the kicker here for anyone tracking retail health, comparable store sales or comps grew by a robust 5.0%. Pretty stellar, right? I mean, this looks like a clear beat and raise quarter.
Oh, absolutely stellar on paper. Yeah. These are the kind of numbers that, typically you'd expect the stock to soar. What's so fascinating here, and really the immediate puzzle for us, is that stark difference, right, between these excellent financials and how the market reacted almost immediately. On August 28th, the day of the call, DKS stock closed down significantly, 4.84%. And that was on really heavily elevated trading volume. This wasn't just a slight dip, It suggests that while the core fundamentals are strong, maybe even getting stronger, there's something deeper, maybe more unsettling at play that investors are grappling with. It implies the market is looking past these good numbers to, something else entirely.
Exactly. And that's where we need to dive in. It's a real head scratcher, isn't it, when you see such strong results met with that kind of negative reaction. So before we get to what might have spooked the market, let's explore what did drive these impressive core results for Dick's. Where's all this momentum coming from?
Well, the comparable store sales growth, that really stands out, and it doesn't seem like a fluke. The 5.0% comp growth, it was mainly driven by a 4.1% increase in the average ticket size. So people are spending more each time they visit, but it was also coupled with a 0.9% increase in transactions. So more people are visiting too. And importantly, this isn't just a one-off. It actually builds on a 4.5% comp increase last year and a 2% increase back in 2023. That really signals incredibly sustained momentum for their core business. It tells you they have a sticky customer base and their strategies are working. Profitability also looked healthy, saw some good expansion. Gross margin expanded 33 basis points to 37.06%. That's nearly 1/3% better profit on every dollar of sales. And within that, the merchandise margin itself expanded by 18 basis points. And their EBT margin, earnings before taxes, was solid, 14.0%, up 9 basis points year over year. The balance sheet looks pretty strong too. DKS finished Q2 with $1.23 billion in cash. Inventories, they were up about 7% year over year to $3.4 billion. That seems manageable, suggests they're stocking for growth but not overly burdened. And they returned quite a bit to shareholders. Repurchased $299 million in shares, average price $218.65. Plus, they declared a quarterly dividend, 1.2125 cents, payable September 26th.
Okay, that paints a very clear picture. Financial health, strong operational execution. But you mentioned something earlier about strategic long-term investments hitting SG&A. Selling, general, and admin costs. Can you elaborate on that? Because it sounds like they're spending big, but maybe for a good reason.
Exactly. That's a key point. We did see non-GAAP SG&A expenses increase 9.9% to $864 million. Now, that means those costs grew faster than revenue, so it led to what we call deleveraging, about 105 basis points. And additionally, you had pre-opening expenses for new stores at $12.3 million. But management was pretty clear. These aren't just runaway expenses. They are strategic long-term investments.
Yeah.
So it's not just a line item. It's kind of a bold statement, isn't it, that DKS is willing to maybe sacrifice a little short-term margin for what they see as like long-term ecosystem dominance. It feels almost like a tech company strategy sometimes, not traditional retail. It suggests they're really rethinking their business model. It's a calculated risk, sure, but could pay off big if they execute well, maybe create entirely new, higher margin revenues down the line.
That's a crucial distinction. Yeah, it signals a much more ambitious vision than just selling stuff.
Yeah.
So the financial health is clearly there, even with this strategic spending, which leads me to wonder, what exactly are these strategic investments funding? What are the key growth levers DKS is pulling beyond just solid execution in their, existing stores?
Well, they're really focused on several strategic pillars that seem to define their future. First, that store portfolio repositioning you mentioned, it's critical. In Q2, they opened 1 new House of Sport and 4 new Fieldhouse locations. But the acceleration, that's coming in Q3. They have really aggressive plans. 13 more House of Sport and 6 more Fieldhouse openings. That's actually their highest number of House of Sport openings in a single quarter ever. For the full year 2025, they're aiming for around 16 House of Sport and 15 Fieldhouse openings, which brings the total count to about 35 House of Sport and 42 Fieldhouse locations, roughly. And management keeps emphasizing these new, more experiential formats. They say they're driving strong financial results and, importantly, deeper engagement with customers, or athletes, as they call them.
Right, so it's not just building more stores, it's building a different kind of store, an experience. But let me play devil's advocate here for a second. What's the biggest risk you see in relying so heavily on these experiential formats, especially if the consumer environment tightens up? Are people really prioritizing an experience over just value right now?
That's a fair challenge, absolutely. The risk is always there, especially with higher capital costs for these builds. However, DKS's bet seems to be that these immersive experiences build much deeper customer loyalty, and they drive higher average spending per visit. That makes them more resilient, potentially. And they are seeing broad-based category strength right now, growth across footwear, apparel, team sports, golf, pretty much everywhere. Management was explicit, actually, said they're seeing no signs of consumer slowdown, and they attributed the demand to innovation and newness from their brand partners, not relying on heavy promotions. That suggests consumers are willing to pay for quality and, well, new stuff. Their e-commerce and digital strategy is also a major highlight. I mean, it's a multi-billion-dollar e-commerce business already, and it continues to grow faster than the company overall. And then there's GameChangers. This is really interesting. GameChanger, which is essentially a sports tech platform for youth sports teams. It's a highly profitable subscription business. It saw 5.5 million monthly active users in Q2. That's up 16% year over year, and 7.4 million unique active users overall. It's on track for nearly 50% revenue growth for the year, and it feeds directly into their Dick's Media Network, DMN, for targeted advertising. So yeah, this isn't just some side project. It's a significant high-margin piece of the DKS puzzle. It almost makes you wonder, are they quietly building a sports media tech company disguised as a retailer?
A sports media empire, you say? So we're talking about a fundamental shift, potentially, moving beyond just selling shoes and balls. That's quite a vision. And you mentioned AI integration too. How deep is this really? Is DKS truly leading the pack here? Or is this just, standard industry buzzwords?
Good question. They are integrating AI into various tools, things like search functions on their site, teammate scheduling in stores, and product assortment planning. The goal is to drive productivity and enhance that athlete experience. Now, while lots of retailers talk about AI, DKS seems to be showing tangible applications that directly impact efficiency and customer engagement. It sounds like they're deploying it strategically, where it can have immediate measurable benefits rather than just, for PR. And let's not forget their vertical brands, their private labels like DSG, CA, Burst. They're performing exceptionally well, apparently offering 700 to 900 basis points higher margins than the national brands. That's huge. It gives them more control over product, pricing, and crucially, profitability, which just further strengthens that core business.
Okay, so let's recap that core. Firing on all cylinders, smart strategic investments, maybe a potential tech empire emerging from game changers, expanded profitability from private labels. Wow. Given all this underlying strength, how is management positioning DKS for the rest of 2025? Are they feeling as optimistic as these Q2 numbers suggest?
They absolutely are, and they've backed it up with raised guidance. DKS actually raised its full year 2025 outlook. And it's really crucial to remember this guidance explicitly excludes any impact from the Foot Locker acquisition. This is just the core DKS business. They raised their non-GAAP EPS range to $13, $14.50. That's up from $13.80, $14.40 previously. Net sales guidance also increased, now $13.75, $13.95 billion, up from $13.9 billion. And comparable store sales expectations bumped up too. Now plus 2.0% to 3.5%, up from plus 1.0% to 3.0%. So this raised guidance coming off such a strong quarter really speaks volumes about their confidence in the underlying business, right? They still expect full year gross margin to expand, reinforcing that profitability trend we saw. Though they do anticipate SG&A will continue to deleverage a bit because of those strategic long-term investments we discussed. Operating margins are expected around 11.1% at the midpoint, with maybe even a 10 basis point expansion at the high end. Management did acknowledge navigating a, quote, complex and dynamic macroeconomic environment, and they confirmed the updated guidance fully considers any expected tariff impact. impacts. So yeah, they're feeling confident, but still appropriately cautious about the bigger economic picture.
Okay, so a fundamentally healthy business, hitting its targets, raising guidance, investing aggressively in its future. Yet, as you pointed out right at the start, the stock dipped significantly on earnings day. Despite all this solid performance, the market clearly had something else on its mind, didn't it? What's the big elephant in the room that seemed to just overshadow these stellar results and that increased guidance?
It absolutely did overshadow it. And this raises a really important question about, market focus versus reality and risk perception. Despite the strong core results, despite the very confident management sentiment, I mean, you have Executive Chairman Ed Stack saying momentum continues to build, CEO Lauren Hobart seeing tremendous opportunity with the Foot Locker business. Despite all that, DKS stock dropped nearly 5% on the day of the call. This is what we often call deal overhang. The $2.4 billion Foot Locker acquisition, well, it received all shareholder and regulatory approvals. It's on track to close very soon, September 8, 2025. Financing is a mix. Cash, their revolving credit facility, and some new debt. Management expressed huge enthusiasm for the strategic rationale. They view the deal as creating a, quote, global leader in sports retail, serving a broader customer base, strengthening partnerships with top brands like Nike, which is, interestingly, re-embracing wholesale after pulling back for a while, and significantly expanding their total addressable market, their TAM. So this isn't just about adding stores. It's really about opening up entirely new customer segments, new product categories DKS might not have reached otherwise. It fundamentally shifts the ceiling for their potential growth, lets them capture a much bigger slice of that global sports retail pie.
That vision, yeah, it sounds compelling on paper, especially with Nike seemingly playing ball again with wholesale. But the market clearly isn't entirely convinced, or at least it's very nervous. What are the specific integration risks that investors seem to be so focused on, the things making them ignore these otherwise excellent DKS numbers?
Well, the market reaction definitely signals investor concern about, the non-trivial integration risk. And they are significant. You're talking about potential store overlap. How do you make sure Foot Locker and Dick's don't just steal sales from each other? Clear banner positioning is key. Then there are massive cultural integration challenges, bringing together two large organizations, always tricky, complex IT system integrations. That's a classic M&A headache. And let's not forget, Foot Locker itself has been a business facing some headwinds. DKS needs to turn that around. So it's a big, complex undertaking. And the market tends to penalize for M&A risk, even when the strategy sounds good on paper. Management does expect the deal to be accretive to earnings in the first full year after closing. They reiterated synergy targets of $125 million, and that notably excludes any revenue synergies. However, the exact level of accretion, how much it adds to earnings, will depend a bit on the final mix chosen by Foot Locker shareholders, how much cash versus how much stock they take. That can make a difference. So near term, investors are going to be watching very closely. The Foot Locker deal close itself, those initial synergy and integration milestones, how the holiday quarter performs with both banners, and any shifts in brand allocation. Lots to watch.
Right. It sounds like DKS is performing some serious retail gymnastics here. Strong core performance, but the market's got television fixed on Foot Locker. Is this a common pattern we see, where a fundamentally strong company gets punished for making an ambitious M&A move? Or is something uniquely concerning about this particular deal that's got the market spooked?
Oh, it's a classic pattern in M&A, really. Investors, they love certainty. And acquisitions, especially large ones, introduce a whole lot of uncertainty. The market is effectively saying, okay, nice core business, but show us you can actually execute this massive integration, rather than just taking management's word for it. The concern isn't necessarily that DTS can't do it, it's just that it's a monumental task. And investor focus shifts from that excellent organic growth we talked about to the potential for missteps during the integration. It becomes a higher risk, higher reward scenario. And the market, maybe in its current cautious mood, is valuing it more on the risk side of that equation right now.
Okay, now for a segment where we explore some, let's say, wild yet plausible trade ideas. And remember, everyone, this is purely for discussion, definitely not a recommendation. We've identified this really fascinating disconnect, right, between DKS's robust performance and the market's deep anxiety about the Foot Locker M&A. What's a plausible way an investor, maybe playing within the lines of this specific scenario, might look to capitalize on that divergence?
Okay, well, given the market's reaction, which seems almost irrational, right, to DKS's beat and raise quarter, a reaction driven almost entirely by this perceived integration risk with Foot Locker, I'm thinking about something like this. A long DKS position paired with a relatively short-dated out-of-the-money put option against DKS. The rationale here, it feels compelling based on the call. The core DKS business is demonstrably strong. We just went through it. Raised guidance excluding Foot Locker impacts. You've got robust new store concepts, those growing digital platforms like GameChanger, clear category strength. The market appears to be overly discounting DKS stock because of the Foot Locker deal. It's essentially creating a potential value opportunity in the underlying strong business. Now, the put option here, it's not just a simple short bet against the company. It acts more like an insurance policy, a hedge. It allows you to limit your downside risk, specifically if that Foot Locker integration hits a major snag right after closing, which seems to be the market's big fear. But it still preserves substantial upside potential if the market's current fears about the deal turn out to be overblown and the underlying DKS business continues to impress, potentially leading to a re-rating of the stock. So this strategy, it really aims to capitalize on that divergence. We identified the gap between strong fundamentals and the negative sentiment-driven sell-off while prudently acknowledging that inherent M&A execution risk.
That's a really interesting way to potentially play the current sentiment versus the underlying strength. Essentially, hedging against the market's anxiety while betting on DKS's core fundamentals to shine through eventually. Okay, so to recap our deep dive today. Dick's Sporting Goods, they delivered an exceptionally strong Q2. They raised their full-year guidance based on the impressive strength of their core business, a core business which is itself undergoing a pretty fascinating transformation with new stores and digital platforms. However, the market's focus, maybe even obsession right now, has clearly shifted to the impending Foot Locker acquisition and all the potential integration challenges that come with it.
Exactly. And if we try to connect this to the bigger picture, the real story moving forward isn't just DKS's impressive organic growth or its emerging sports tech ambitions. It's really about how successfully they integrate Foot Locker. Can they pull it off smoothly? The next few quarters, they're going to be absolutely critical. They need to demonstrate their ability to execute on this really ambitious expansion. If they do, it could solidify their position not just as a leading U.S. retailer, but as a genuine global leader in sports retail. So the question maybe for you, the listener, to ponder is DKS merely making a bold strategic bet here? Or are they truly laying the groundwork for a new kind of sports and media empire, with Foot Locker maybe just being a stepping stone rather than an anchor weighing them down?
That's a powerful thought to chew on indeed. Thank you for joining us on Talk Tickers. Remember, this deep dive is for informational purposes only. It is definitely not financial advice. We encourage you to continue your own research and exploration. Until next time, stay well informed and keep digging.